Hello, this is the online lecture looking at elements of income and cost. My name's Gareth. Well, to start with, we're going to think briefly about income, and then we're going to spend a little bit more time looking at costs. Well, what is income? Well, income goes by a variety of different names in accounting. Sometimes it might be described as sales. Sometimes it might be described as turnover. Sometimes it might be described as revenue. Just a variety of different terms for essentially the same thing, which is the money coming into a business because of what they do in their organization. Now, for a commercial entity, income is from making sales to customers. We actually saw in a previous online lecture some different types of business organization, and they'll generate revenue, generate sales, generate their income from doing different things. For instance, manufacturing businesses, now they're the ones that make something physical, and so they will generate their income from selling the physical products that they're manufacturing. So a car factory that manufactures and builds cars, they generate their income from selling those cars to customers, the money that you pay to buy the car. Retail businesses, on the other hand, don't make anything. They buy products from other companies and then sell them on. So supermarkets like Tesco, their income is generated from selling milk and bread and packets of cereal and wine that they've purchased from other organizations. We also thought about service businesses that don't sell anything physical but provide some kind of service, and they generate their income by charging for that service. So a bus company obviously charges you fares for your tickets, and that's their income. Now, this is when we're talking about commercial businesses, organizations that are trying to make a profit. There are other types of organization that also have income. For instance, in the public sector, the likes of the NHS, they receive income in the form of grants from the government, which allows them to spend money on employing nurses and paying for their premises of the hospitals. Charities such as Oxfam, well, their income would be donations that they receive from the public. So when they have big campaigns to try and raise money, they'll receive donations, which is their income. They may also potentially have a shop. You often see charity shops that sell second-hand clothes, and again, the amounts of money they raise, that would be part of their income. So income is the money coming into an organization because of what they do. Costs we can think of as the money going out of an organization. Now, what we're going to see, and in fact part of the principle of this paper, is looking at costs in various ways. You can imagine the name of the paper, Basic Costing, and it's an area that your studies will progress when you move to level 3, when you look at the costs and revenues paper, and even when you get to level 4, there's a couple of papers at level 4 of the AAT, Budgeting and Financial Performance, and you'll see an awful lot of development of your understanding of the concept of costs. But to start with, we're going to think about some of the different ways we can categorize costs. And there's several different ways we can do it. Now, if we start at the bottom of the page here, looking at a couple of different ideas, there's capital expenditure and revenue expenditure, or sometimes abbreviated to CapEx and RevEx. Now, capital expenditure, this is where we're spending money on something that will last for more than a year. So good examples might be buying a car. You can imagine if you buy a car, it's likely the business will have it for several years. If you buy a machine or a computer, even if you're buying desks for the office, they're likely to last for several years. If you're buying premises, if you're buying a new factory, that could last for decades. So CapEx is where we're buying things that will last for more than a year. Now, in terms of how we account for that, it creates a fixed asset. A fixed asset is an asset that we're going to keep for more than a year. Now, if you've already seen the basic accounting papers, you'll be conscious of the concept of the balance sheet, and the balance sheet showing assets and liabilities. So CapEx would create a fixed asset that we'd put on the balance sheet. Well, if CapEx is where we're spending money that's going to last for more than a year, RevEx is where we're spending money that will last for less than a year. So a good example might be paying monthly salaries. Obviously, if you pay your staff their monthly salaries, they will continue working for you for another month, but then if you don't pay them the following month, they'll go elsewhere. So that monthly salary run only benefits you for 1 month, less than a year. Similarly, if you're paying your rent for your factory, that's likely to be the monthly or possibly quarterly, but you would normally be paying for far less than a year in one go. Now, rather than creating an asset on the balance sheet, we actually take revenue expenditure to the profit and loss account, and it gets treated as an expense. So it would be a reduction to profit for that period. It doesn't create an asset because we're not going to benefit for several years. Well, there's a little example, just a list of costs here. And you can have a go at identifying whether each of them would be treated as capital expenditure or revenue expenditure. So perhaps put me on pause while you have a go at that, and then you can restart me. Well, what did you think? So we've got purchase of a new van. Well, would buying a new van last for more than 1 year or less than 1 year? Well, I suspect a van would last for several years, so I think we'd probably count that as capital expenditure. A van could last for several years, so we would treat that as a fixed asset on our balance sheet. We've then got factory rates. Well, will that last for more than a year or less than a year? Well, generally businesses pay rates on a monthly basis, and so when you pay your rates, you're only going to benefit for less than a year, so I would treat that as revenue expenditure and just treat it as an expense in the profit and loss account for that period. We've then got repairs to machinery. Now, this could be a bit judgmental. If you repair your machinery regularly, which most factories will do to keep them in good running condition, we would probably assume that the benefit will be for less than a year, and repairs to machinery would normally be treated as revenue expenditure. You can imagine you probably need to maintain and repair your machines at least every year, if not more regularly. And then a factory extension. Well, if I'm extending the factory, I suspect that will be lasting for many, many years, so I would probably treat that as capital expenditure, and so that would become a fixed asset on the balance sheet. So that's just a little example of treating elements as either capital expenditure or revenue expenditure. Let's have a look at another way of categorizing costs. Well, we can categorize costs by their function. And I think of this as being where in the organization is the cost being incurred. And fundamentally, you can kind of break this down into two broad categories. We've got production costs. Production costs are any costs incurred in the factory building. So you can imagine the purchase of raw materials for the production process, the rent of the factory itself, payment of any salaries to factory workers, the production staff. All of these would be treated as production costs. So if you just imagine any cost going on in the factory building itself as a production cost, anything else we would treat as a non-production cost. And again, we could even break that down further. You may have an administration department, so paying the salaries of your accountants, paying the salaries of your receptionists. You may have selling and distribution, so the delivery drivers' wages, the petrol for your lorries to take the product to the customers, even your marketing. So if you pay for adverts on TV, that could be treated as selling and distribution. So production costs, anything going on in the factory. Non-production costs, basically anything else. Now, one thing to bear in mind, we're looking at the management accounts of the business here, and in management accounting, there's no correct single one way to do anything. It's up to your business how you choose to treat items and how you choose to break them down. So in your organization, you could decide exactly how you are going to categorize costs. You may, for instance, if you're a pharmaceutical business, so producing drugs, you may want to have an R&D function on the basis that you're spending a lot of money developing new drugs to sell to customers. Well, another little example here to have a think about, just looking at some different types of costs and trying to categorize them. Are they, firstly, production? So do they go on in the factory? Or are they non-production? In fact, even within non-production, can we categorize them as either administration or selling and distribution? So again, perhaps if you put me on pause, have a go at this example and then restart me. Well, what do you think? So starting with raw materials, so the physical products that we're buying to produce our products with. So if I'm a car factory, buying wheels, buying gear sticks, and I'm thinking those sorts of costs are definitely in the factory itself because they're part of producing the cars. So I'm thinking raw materials would probably be treated as a production cost by most organizations. We've then got factory staff wages. Now, the fact that we're told it's for the factory staff, they're obviously in the factory. So I'm thinking that's also a production cost. We've now got payment to another type of staff. We've got delivery driver salaries. So I'm thinking delivery drivers would be part of the selling and distribution process of the organization, taking our products to the customers. Factory rent, well, again, it's about the factory, so treat that as a production cost. You can imagine that we'll have other elements to our rent. We might have rent of the head office, which might be more of an administration cost, but I think the factory rent, definitely production. We've then got finance director salaries. Now, the finance director will probably be part of the finance department, part of the accounts department, which would be treated as administration. We've then got another of the board of directors, the sales director, and his salary. Well, sales director's probably more to do with selling and distribution. Now, he'll be running the sales teams, marketing and advertising to customers. We've then got depreciation of office computers. Now, you may have come across depreciation. Depreciation is just the expense we suffer as the value of assets drop, assets wear out. You can imagine a car loses value as it becomes older. Well, depreciation of office computers, I think I'd probably treat as administration. If it had been depreciation of production machinery, some machines in the factory, we'd probably have treated that as production costs. Okay, so we've got production and non-production costs there, and we could break non-production costs into administration, selling and distribution, R&D, research and development if we wanted to. Now, production costs can actually be further subdivided if we want. And again, some terminology here, quite important, and you'll come across over and over again in your studies, the difference between direct costs and indirect costs. Now, a good way to describe direct costs is as traceable costs. So direct costs are any costs that can be traced to individual units of production. So for instance, let's imagine a car manufacturer. Every single car that you make needs 4 wheels. So 4 wheels could be traced to each particular car that you're producing. Each car will also need a gear stick. So you could trace the cost of 1 gear stick to each car. Each car will need 2 seats in the front. So you could trace the costs of those seats to each car. So direct costs can be traced to individual units of production. Now, if you add up all of the direct costs of an organization, we would get what's called the prime cost. So that's a term that's worth becoming familiar with. The prime cost is just the total of all of the direct costs of the business. So direct costs are traceable, can be traced to individual units. Indirect costs cannot be traced to individual units because they're shared. They're shared over lots of units. You can imagine the rent of the factory. If I'm a car manufacturer, I can't trace the rent of my factory to a single car I've produced. If I'm paying monthly rent, that rent is shared over all the cars I produced in that month. So whilst I could trace the cost of wheels to each car, I can literally see 4 wheels going onto each car, so the wheels would be a direct cost. The rent, your rent bill, you can't trace to a single car. Similarly, electricity. You can't trace your electricity bill for a 3-month period to one car that you made. It's shared over all the cars in that period. So indirect costs are shared over many, many units, and because they're shared over many, many units, another term you'll sometimes see used to describe them is overheads. So overheads, just another term for indirect cost. Well, little example to see if you can match again some different types of costs to some business, to whether they're direct or indirect. So again, why don't you pause me for a couple of minutes while you have a look down this list of 6 costs, just see if you can identify, is each of them a direct cost? So can it be traced to an individual unit of production, or is it an indirect cost? Is it shared over lots of units of production? Well, we're looking here at a manufacturer of cakes. Well, what about the supplies of flour? Well, I'm guessing they're buying the flour to make the cakes. I'm imagining that there'll be a certain amount of flour required for each cake. So let's say they need 0.5 kilogram of flour to make each cake. You could trace 0.5 kilogram of flour to each unit that they're producing. So I think that the supplies of flour would be a direct cost, can be traced to each unit. Well, we've then got the wages of the cooks. Well, I'm guessing that the cooks are actually stirring the mixture together, putting it into the cake tins. They're actually baking the cakes. They'll be icing the cakes and putting a little glacé cherry on the top. So I'm guessing that if it takes the cooks 1 hour to bake each cake and to ice it, then you could trace an hour's worth of their wage to each cake. So I'm thinking that the wages of the cooks would be direct again, could be traced to the cakes that they're making. I think of that as the fact that the cooks are physically working on the cakes. You can imagine they'll be physically touching the cakes. We've then got an electricity bill. Now, typically you get electricity bills for 3 months at a time, a quarter. Could you trace a 3-month electricity bill to one cake that you've made? Well, no, I don't think you can. I think the electricity bill would be a shared cost over all the cakes produced in that period. Rent of the factory, I think similarly, you can't trace the rent of the factory to a single cake, so that would be a shared cost. That would be another overhead. Remember that term for indirect costs, overheads. We then got the cost of a box for each cake. Could you trace the cost of a box for each cake to individual units? Well, yes, I think you could, because each cake needs a box. So I think that the cost of a box would be a direct cost, can be traced to each individual unit. And in terms of the salary of the factory manager, well, in contrast to the cooks that we've already looked at, the factory manager will not be working on individual cakes. You can imagine they'll be managing the overall production process. They'll be dealing with an awful lot of different aspects of the business. So I think that the salary of the factory manager, again, would be an indirect cost. It would be shared over all of the production in whatever period you're paying them. So it can't be traced to individual units. So we've been looking at the top of this page at production versus non-production. And remember, this is looking at further subdivision of those production costs into direct costs and indirect costs. And then final couple of things to think about in this lecture. Other ways to categorize costs, we can categorize them by their nature. In fact, we sort of started talking about these already. There are 3 basic natures. We've got material, labor, and expenses. Well, material is where you buy anything physical, anything you can touch. So buying wheels for a car factory, you can touch a wheel, that's a material. Buying the gear boxes to go into the cars, that's physical, that's a material. But it doesn't actually have to be physical materials to go into the cars even. If you're buying bacon for the canteen, bacon is a physical thing, so it would be a material. Labour is when you're paying staff for their time. So paying the production workers to build the cars, that would be labour. Paying the sales director for his time, that would be labour. Paying the delivery van drivers, that would be labour. So labour is paying staff their time. And then expenses is essentially anything else. So material is the purchase of physical things. Labour is paying people for their time. Expenses is anything else. So a good example of an expense would be rent. The rent you pay to occupy your factory for a month would be an expense. So we can categorize costs by their nature, material or labour or expenses. And we can even categorize costs by their behaviour. And there are two cost behaviours we'll actually look at in a little bit more detail later in this syllabus. We've got fixed costs and we've got variable costs. Now, whether a cost is fixed or variable is to do with whether it changes if you increase the volume of production. Fixed costs do not change, so they are unaffected by the volume of production. They're fixed. So for instance, your rent. Your landlord doesn't care how many units you produce, they will still be charging you the same monthly rent. Even if you produce nothing, they don't care, they will still charge you the monthly rent. So rent is a fixed cost. It stays the same regardless of how many units you produce. Now, be a bit careful. Don't make the mistake of thinking that fixed costs cannot change. Your rent could go up. Your landlord could put your rent up. But that's still a fixed cost because that change has nothing to do with the volume. They haven't put your rent up because you've produced more units. They've just put your rent up because of inflation. They've just decided to increase your rent. So fixed costs can change. It's just that they don't change because of the volume you're making. Variable costs, though, do change with the volume of production. They vary. So the more you produce, the higher the cost. Good example might be direct material. For instance, the wheels on our cars. If you double the output of cars, if you produce twice as many cars, you will need to buy twice as many wheels to put on those cars, and therefore the cost will double. So variable costs do change with output. But we'll be looking at that idea of cost behaviour in a little bit more detail later in the syllabus.